Welcome to the Building Bite Podcast, a podcast for construction contractors, owners, and insurance professionals, where you can hear from the experts about key topics to help you be successful. My name is Peter Duggan. I'm President and CEO at Proactive, and I'm here with my co-host, Mike Diercksen, Proactive's Senior Innovation and Content Solutions Consultant, and our featured guest, Jim Bly, Managing Director of Alliant Construction Services Group in Pittsburgh, PA, and National Subcontractor Default Insurance and Surety Analytics Leader at Alliant Insurance Services. Jim, how are you doing today?
Good, Peter. Good to see you. Thank you.
Good to see you as well, Mike. How are you?
Doing great, Peter. Really excited to connect again with Jim and learn a little bit more about the data side of this.
Yeah, I know. That is such a key topic. And that is our topic today, right? The evolution of subcontractor default insurance as seen through data and analytics. And Jim, we know from your title, you are a data and analytics guy, so nobody better to talk about this topic. Before we get into that, can you tell us a little bit about your background and how you got to where you are now?
Sure, Peter. Thank you. So I started in the business in 1981 as a surety underwriter and continued down that track for about 15 years. And then while I was at Fireman's Fund Surety, we created a surety credit model to risk rate our book of business. And I took a keen interest in data and analytics. And it really proved to be a very helpful tool in our extension of surety credit, and helped us identify the high-risk subs in our portfolio or high-risk contractors in our portfolio, so we could spend our time really managing the risk where it needed the most attention. And once I became a broker in 1996, we brought this credit model to the market. So it's essentially bringing a surety underwriting tool for use by others in the market, including general contractors, construction managers, owners, lenders, and equity investors in projects. I was also one of the founding members of the Construction Financial Management Association in Pittsburgh, and I've been an at-large board member for the CFMA nationally. And then I was able to sit with the AICPA and the Financial Accounting Standards Board on a credit committee giving advice to FASB about quality of financial reporting and what is really important to potential creditors of contractors and evaluation of risk. In 2015, after 19 years with Marcia McLennan, I opened the Alliant Construction Services Group office here in Pittsburgh and have been part of the national team at Alliant Construction Services since 2015.
So you've seen a thing or two in your career, sounds like?
Yeah, I've been through several economic cycles.
Well, it'll be interesting to get into that. And let's start with the current landscape and what Alliant is doing utilizing that data. It sounds like that model that you've talked about, that's been in formulation for decades. Tell us, How is Alliant utilizing that data and how is that impacting the marketplace?
Sure. So really this, we call it our C2M model. It's a contractor credit model. And we look at 10 criteria through the lens of a surety underwriter, because sureties, their business is based on contractors remaining solvent and meeting their obligations. So we start with the quality financial reporting, and then we turn to the liquidity of the contractor in relation to what we believe their anticipated backlog will be to support their historic revenue. And then we look at their equity and their leverage and how much borrowing capacity they have available using traditional metrics on their fixed assets and current assets. And then we look at their historic earnings and cash flow. And we love to review work in progress schedules and look for some of the more detailed analysis that's available in a work in progress schedule, including late stage underbillings, overbillings that might include profit contingencies that could materialize to the good. We try to look at gains and fade ratios over time on work in progress as it completes. Do margins go up or down? And how much cushion do they have in their current balance sheet? And then we've expanded our credit model to use a calculator effect. So we set credit limits based on their historic jobs completed, Usually the single job limit is like 1.25 times the largest job completed, or no greater than 25% of their aggregate work program. And we had a situation a few years ago with a client where we analyzed a contractor and we set a credit limit of $2 million per project, $8 million work program. And we scored the sub. We have a 4-quadrant scoring system. 0 to 25 is high risk, 25 to 50 watch list, 50 to 75 is the better risk group, and then over 75 is best in class. So we rated this sub a 32, and they failed within like 10 months. And the client came back to us and said, what's going on? This sub failed. We asked them, well, what size of job did you award? Well, we awarded an $8 million project. We're like, well, I wish we would have known that, because that would have had a big impact on their score. We look at their liquidity to manage a single project and to manage a work program, and the $8 million project put them way over their aggregate 8 and way above their single $2 million size. So we reran the score, and it was a score of 21, clearly in the high risk group. So now we've developed a calculator where we'll set the single and aggregate limits in the credit score. And then if you want to plug and play to see, well, if I award 1.5 times their project limit, what impact does that have on the score? So, often we're seeing 15-point swing in the score if you start getting more than 1.5 times the size of job that we recommend. So, the tool's very interactive. We have about 4,500 subs in our database, and we analyze those subs annually for a whole range of clients: construction managers, owners, lenders, and equity participants in projects.
So if I'm a general contractor out in the marketplace and I want to get a hold of this calculator tool, how do I do it?
You can contact me, and we've got an electronic portal, and the subs can go in, log in their information, and then the client using that portal can look at that credit score online and the capacity limits online, and then they can plug in the size of project they want to award and see the impact on the score.
That's really something. I think the instant use, right? Taking that data, but incorporating it in real time before you award the project is really something special. And Jim, so speaking of the current environment, I don't think you really can talk about the current environment without COVID. So you said you had 4,500 data points on different subs. How has COVID affected the marketplace? And with these tools, what are you seeing in that?
Yeah, COVID has had a dramatic impact on the market as far as PPP funding goes. So as you know, subcontractors with less than 500 employees were eligible for PPP funding regardless of their need, as long as they were concerned at the time they applied for the loan and used the loan to fund payroll and stayed within the guidelines. Those loans are being forgiven now, and it strengthened the strong and prolonged the weak. We had a number of subs that were in a heated market prior to COVID. And what's the number one cause of subcontractor insolvency? Overeating. So a number of subs had very large backlogs. There was a labor shortage. There were some problems emerging in the market because of all of the activity, and there's all of a sudden new capital coming in the form of the PPP round 1, round 2, and employee retention credit. It's been a dramatic improvement overall to a number of subs, and really saved a lot of subs and solved a lot of claim problems. There, was COVID, all the impacts of COVID, the productivity impacts, the ability to get materials, the price escalation, all the things that the government shutdowns of jobs, remobilization, the buttoning up jobs, all of those costs. There would be so many more claims out there had it not been for the PPP funding. So.
Right.
It was. It's been terrific to see the impact of that on a lot of subs. Unfortunately, we believe it's only prolonged the inevitable for some of these subs. But for now, we're not seeing the problems we certainly would have without it.
So, Jim, I'm loving what we're talking about this with the data, and I know that there's a big emphasis in the marketplace right now to maintain a certain level of accountability, right? With the data pre-qualification for subcontractors, that is from a whole market standpoint, a very important thing. But going back to the implementation of SDI in the 90s, it wasn't always the case, correct?
Absolutely. It was the Wild West in the 90s and really through 2008. The underwriting discipline by the insureds for this product was lacking. Many general contractors didn't have a very sophisticated review of subs, or they just overlooked some of the review that was going on just to enroll subs in the program that weren't qualified. There was not a lot of discipline around risk mitigation. And, the product was doing well. I mean, Zurich was the only player from 96 to 2008. It took a while for them to get ramped up. Then they started generating a lot of premium. It was the most profitable line of business they had. They wanted more and more, and they were trying to create a market. So, they did a good job of that. They got the word out. People started using it more and more. And, through 2008, there were some pops here and there, but overall, the product was doing quite well. We had one of the early SDI losses on PNC Park here in Pittsburgh, but we found that, we pointed out some high risk subs on that project and pointed it out to the insured and to the underwriter even at that point. And they're like, we've used them before, they're good. And the underwriter's like, if the GC's comfortable, put them in it. Don't worry, no risk mitigation, just let's go. So, insolvency and defaults, it should be a high severity, low frequency line of business.
And Jim, when we talked last, we talked about how 2008 was a little bit of a turning point, right? So you mentioned the wild, wild west in relation to insureds pre-qualifying subs in the 90s, and then things matured a little bit. And then here comes 2008. Can you tell the audience a little bit about what happened with SDI from 2008 going forward?
Sure. Well, 2008, as many of you remember, was the Great Recession. And, what caused that? We had a banking crisis. When I live in Pittsburgh, I used to say, in 2010, tell me a city within a 5-hour radius of Pittsburgh that has 20 tower cranes between the airport and downtown. Nobody could tell me. It was Toronto, Canada. I used to go up there because they didn't have the banking crisis, but every other city was shut down because lending had tightened up. There were a lot of defaults, a lot of sloppy loans and default swaps, and the carriers that were writing those products went out of business, and we had all kinds of problems. So the industry really did come together, and a lot of clients recognized the issue, and then they were enticed or encouraged to have more skin in the game. So the per claim retentions went up for SDI, the aggregate retentions went up, more risk was pushed to the insured, so the insured would pay more attention, and then the insureds got a lot more sophisticated evaluating credit risk. And they've either hired consultants or third parties to help them manage and gather information and do credit scoring, or they've developed, some clients have developed very sophisticated in-house pre-qualification models that, have really helped turn their SDI program around.
And so, Jim, would you say that this is the fix that's kind of reset the market, that shared accountability? Is that what really has taken us from then to where we are today?
Yeah, yes and no. I mean, that reset of the market certainly slowed down the multiple defaults on one job and slowed down the frequency of SDI losses. From 16 to 18, we definitely saw, the labor shortage, and XL is, now the largest underwriter in SDI, and they've had a few bumps in the road. Overall, very profitable line of business for them. But we did see, labor shortage and, some issues with overextension and some specific trades, which we'll talk about, that caused some problems. And now, with COVID, the impact of that, certainly we're monitoring the impact of COVID. Hopefully we don't have a double dip recession, which could accelerate problems, but we think there are possibility of coming problems here in late 22 into 23. We could start to see some further erosion in the market as far as the quality of subcontractors.
And Jim, I would imagine with that data on the 4,500 subs, you can aggregate that and see a little bit about the strength of those different subs, where they were maybe pre-COVID versus aggregated where they are now. What does the data tell you in that comparison?
Yeah, so that's a great question. So we, of our database of subcontractors, if we look back, and it's usually a bell curve. So, we historically have had about 8% in the high risk over the last 5 years. Maybe we've had 40% in the watch list, and then we've had maybe 7% in the best in class, and the balance in the better risk group. So of the four quadrants, we had historically about 49% over a 5-year period in the high risk or watch list. In 2019, the subs were doing pretty good overall. We had in the high risk, it had dropped to 5%. And in the watch list, we had dropped to about 38% out of this portfolio, 4,500 portfolio. So we had over a 5-year trend, it was 49%. High risk and watch list had dropped to 43%. 2020 hits. And we have seen, and we're still getting some data in from 2020, surprisingly. I mean, our standard is we should see a 12/31 financial statement within 120 days. We're still waiting for some, which is not usually a good sign. Late is usually bad, but they didn't meet their bank covenants. They have a claim they're evaluating. They don't have good internal controls. There's a whole host of reasons. But for 2020, we're seeing the high risk subs back at 8%, and we're seeing an uptick in the watch list subs to 41%. And that's despite PPP funding. So without PPP funding, so that puts us combined at 51% versus 2019 combined at 43% of high risk versus a 5-year average of 49%. So we are definitely trending in the wrong direction in 20. We'll see how the recovery plays out in 21. We are seeing some defaults in the market. And again, as work continues to grow and backlogs continue to grow, a lot of times once you come out of a recession, what has happened? You've lost people, your balance sheet might be a little weaker, and now you're in a position where you're taking on maybe some of the biggest jobs you've ever taken on with fewer people or fewer qualified people and less capital. That's a formula for problems. And I've seen it going back to the late 80s, going back to 2011 to 13. We had some problems in 2003, 2004. If you remember the steel price increase we had Enron, we had Modern Continental, $800 million loss up in the Big Dig. We had a lot of problems in the market. So 03, 04 was even a bit of a challenge, and we saw some losses there. So it takes a little while for these things to develop, and we're certainly keeping our eye on the market and particularly on some of the higher risk subs.
Do you think 2022 and 2023 may look a little bit like 2011, 2012, 2013 based on the disruptions you're seeing?
We're afraid of that. Yes, that we're being vigilant. We think that's a possibility. There's a lot of variables out there. What's going to happen with interest rates, what's going to happen with inflation, what will happen with work availability and size of projects coming out, and then what's happening with labor. That's always a variable.
And so if we break down that 49% that's either watch list or high risk, can you give us and give the audience a sense, are there specific classes of subcontractors that you see more often fit into that watch or high risk area?
For sure. Yeah. So if you look at our credit model, framing contractors, wood framing contractors are probably the highest risk. And I think the SDI market would attest to that. They've seen a lot of loss activity there. Drywall contractors have been a challenge. Curtain wall contractors, concrete contractors, they kind of lead the pack. Those four groups as far as the overall credit score in relation to what we see for all of our subcontractors. And then we do see a number of subs that are pretty heavily borrowed. Masonry and contractors are in that area. We're always watching for subs with less than 25% of their bank capacity available. What are the chances they run out of cash, they trip a covenant, the bank shuts them down? A lot of times that's a formula for a default scenario. So we see masonry, concrete, and actually sprinkler contractors being pretty heavily borrowed in today's market. So those are a few of the observations we're seeing. Electrical contractors, there has surprisingly been a fair amount of activity in that trade as well.
And is there a geographical?
For sure. Yeah. Florida has been a hot spot, and the Sun Belt states, I think, have been more volatile. There were some problems in Colorado. I think those geographies, and then, of course, New York. It's amazing what's happened in New York. It used to be such a strong union town, and now over half of the market up there is non-union. And there's been a fair amount of loss activity in that market as well.
Yeah, Jim, I think the ability that you have to utilize your data and to break it down to that granular level, to dig into geographic markets, it's really something incredible. And so with that said, our listeners typically, this is the Building Bites, so it's BIM, insurance technology, the experts. We have a lot of GCs, risk engineers, carriers on who are listening. What might be some great advice, some takeaways for them coming out of this episode today?
Yeah, so I think there's a whole lot of data being analyzed, but I'm not sure that the data being analyzed is always useful or understood. And, maybe some of the data is garbage in and, of course, creates garbage out. So it's very important that you understand what you're looking at, and you need timely data, and then you need to know what to look for. So, just a couple of quick tips. A lot of people look at, working capital and equity. Well, you really need to understand what is behind the working capital, what soft assets are on the balance sheet. And actually, the FASB came out with new standards for financial reporting where now underbillings and retainage are lumped together in an account called contract assets. And if there's a lack of a footnote disclosure or a lack of a job schedule, we don't know how much of that contract asset is an underbilling or a retainage item. And the risk profile on a retainage item versus an underbilling item is a huge difference. Nobody asked me, but I don't know, why are we reporting contract assets? But could somebody please tell me the value of that? To me, this whole contract asset thing was really meant for manufacturers more than it was contractors. We're all the sureties and the banks that underwrite contractors. We like to see underbillings. Why? Because underbillings include, if they're late stage underbillings, what does that mean? It means it's a claim or unapproved change order, or maybe it's just an overestimation of profit. And then if you can look historically at job profit gains and fades, and if you have a tendency towards fades and a lot of late stage underbillings, you can say, well, here it comes again. So we need to discount that working capital. So that's just one example that, I know a lot of analysts just say, well, let's look at the current ratio of this contractor versus all other contractors in their class. To me, that doesn't tell me anything. You really need to get behind the numbers. There could be overbillings there that include contingencies and potential profit gains, that if you know that gain to fade history of the contractor and they historically have strong cash flow and profitability and job margins are going up at the end, then you take greater comfort extending credit on maybe a smaller working capital, because the quality of that working capital is very sound and it's conservatively reported. So, I think it is important to look, and our portfolio does this. You can say, all right, well, this mechanical contractor has a credit score of 54, and all mechanical contractors as a whole have a credit score of 59. So they're slightly below the average or above the average. That's important to understand. But I think what's more important is you need to get into the weeds. And it's so much more than just ratio analysis, particularly when you start to see through some substantive testing that there could be problems and you need to dig deeper.
And what about an action item, Jim? If there's one thing the listeners could do to start, and they could start today and start thinking about data and analytics, what would you suggest?
really thinking about what are you doing with the data. And, one thing that we try to do, on our electronic platform, we have the ability to do, before award, you can do a comparative analysis. All right, you've got 3 bids, and where does each score? And then what is the capacity limits for each sub? So you can kind of use that data to say, well, all right, maybe this guy's 100,000 low, but his risk profile is so much greater, and he's overextending versus his capacity and his credit score. The chances of us having a problem are pretty significant. Let's take the additional 100,000 in the next bid, and because we're going to spend that probably just monitoring this guy, even if he doesn't default. So, use the data prior to award, and your SDI underwriter will love to hear that. And then, to the extent possible, ask for job schedules. We get them maybe 25% of the time, but when you can get them, it's so much more valuable. I always said as a surety underwriter, if I had one piece of information to look at, forget the balance sheet, income statement, cash flow, give me the job schedule. And that tells so much. What's the gross profit remaining in backlog? How are margins on open jobs versus closed jobs? Where are they from an underbilling and overbilling perspective? All of those things jump off the page when you have a complete job schedule. So, and then just, a rigorous process to mitigate those risks. Once you get the data, once you've identified somebody as high risk, what are you doing with it? Are you joint checking? Are you putting tighter quality control in place? Are you making sure that the quantities installed line up with the amounts billed so those subs aren't getting out in front? And if there is a problem, there's no contract balance left to hire somebody else, exacerbating a problem. All of those things are very important pieces of information when you've identified a high-risk sub. Put the risk mitigation in place.
Excellent, Jim. Yeah. And so as we start to wrap this up, we'd like to always ask our guests a few rapid fire questions. So if you're ready, I got a few lined up for you. The first of which is going to be, what trends are you seeing in the marketplace? We've talked a lot about data and the things that you're tracking. What are some of the trends that you're noticing?
So overall, I think there's a lot more pre-qualification going on. The SDI underwriters are pushing it. And a lot of the SDI underwriters have implemented disciplines where they want to see the analysis of subs over maybe 10 million or 20 million. In the Wild West, it was usually up to $40 million. You just enroll the subs. Or the SDI underwriters have gotten very specific about, all right, for certain trends, for curtain wall, for wood framers, we're setting a sub limit. You can only award up to $1 million or $2 million. Above that, we want to get involved in the underwriting and help you pre-qualify those subs. So we're seeing more discipline coming from the SDI market to help identify problems early on in the higher risk trades.
And so another question, Jim, we always like to ask our guests this, but what is keeping you up at night professionally? Is there something that you're noticing in these trends that you're kind of, in the back of your head always thinking about?
Yeah, I've been through several hard surety markets. The late 80s, like in Pittsburgh here in 1988, 89, we had 100 million of losses, surety losses here in Pittsburgh. And there were all kinds of problems nationwide and very tight credit market in the 90s. And then we had that again in 04. And then to some extent in 11, 12, 13, although the SDI market took a lot of what the sureties would see. But what happens is it's a ripple effect. If you see some large losses in the market, it affects the SDI underwriter appetite and their reinsurer's appetite. So the capacity available could shrink very quickly. The problem we have, the surety market is $6 billion or whatever a premium. The SDI market is 450 million tops. And the SDI markets are putting out 50, a couple are putting up 75 million per subcontract loss limit. You start having several large losses in the market, it wouldn't take many, and all of a sudden the market's upside down. There's fewer carriers, And that's what keeps me up at night, a loss of capacity and a shift where clients have to move back to more traditional use of sub-bonds or a very robust self-insurance process where they're taking very high retentions and really getting disciplined about their pre-qualification. So that could be, and as job sizes keep going up, and we're seeing a lot more mega jobs, that's what could really impact the market, because the market can't sustain itself at this level of premium for the potential losses that could occur.
Yeah. I mean, Jim, we talked about it earlier, how the market kind of came together to increase that accountability and up their game, so to speak. But it doesn't mean that you can stop, right? There has to always be that evolution. You have to continuously improve that, because otherwise, like you said, you could face a situation that might upend the market.
Yeah.
Mm-hmm. And so finally, the last one I have, at least, is where do you see people struggling the most with their data and analytics? I mean, is there something that you keep seeing that you're scratching your head going, why are you still doing that?
Yeah, I think the biggest thing is they don't know how to set the single and aggregate limits. They might identify, I see a lot of people looking at ratios and looking at project experience. Insolvency is still by far the number one cause of default. Occasionally you have labor shortage or schedule busts and people get defaulted, but insolvency drives that. So, I think there's still a need to really understand how much a sub needs based on how labor intensive their business is, how much capital they really need to operate their business, and do they have enough, and do they have access to it? So, I think there's a shortage of evaluation of what the key risk is for sub default, and that's insolvency.
And Jim, if you could share one lesson learned throughout your career with our listeners, what would that be?
One lesson learned. That's a great question. I've learned a lot of lessons. They're very painful. I remember when I was a surety underwriter, a sub came to me. It was a steel fabricator, and he had 3 jobs going. They were all profitable jobs, and we saw them on their whip, but they all got delayed, and he had a bottleneck in his shop, and he couldn't get the product out the door, couldn't get paid, tripped his bank covenants, bank got nervous, foreclosed. And the contractor came to me and said, "You're funding our payroll. It's Friday." I'm like, "Well, what makes you think I'm a bank? I'm a surety." They're like, "No, you're a bank." And he was right. I was a bank. So, the one lesson I would say is you can have a very profitable backlog, but unless you have the cash to manage and get through it, you can still create a lot of problems. And that particular sub was one of the last, it's not why I got out of the surety business, but the underwriting business, but it was one of the last deals that I had that, blew up in the surety world. And it cost the surety $5 million. And then when I left, I became their broker and helped them work through it. And we actually paid the surety back the $5 million because it was, at the end of the day, it was profitable work. We found them alternate financing. The surety cooperated and stepped up. And the sureties are the hidden bank in some instances. And it's actually a good thing for them. With a fabricator, the last thing you want to do is try to take all the stuff out of somebody's shop, ship it somewhere else. The cost to do that is exorbitant. Maybe you want to finance that defaulted sub. So you can have profitable work, a good backlog, but things happen. You need capital. That's the one lesson I've learned.
Yeah, excellent. Cash is king. Cash is king. Jim, last rapid fire question. What is one thing people may be surprised to hear about you?
I am the 7th cousin of Abraham Lincoln, once removed.
I want to see the lineage. Show me the tree.
My cousin did the research on it. But that's my great grandmother's cousin was the first cousin to Abraham Lincoln's wife.
All right. I'm very surprised, Jim. That was a good one. That was a good one. All right. So again, wrapping this up, Jim, this is the Building Bite, as I mentioned earlier. That is BIM Insurance Technology with the experts. You are our expert today. we always like to ask our guests, what are you taking a bite out of today? I know you're in Pittsburgh. Personal favorite of mine, is it the O? Is it Permanente Brothers? What's the flavor of the week for you in Pittsburgh?
Definitely Permanente Brothers. I mean, there's so much history with that. The founder of Permanente Brothers used to be a client, Jimmy Petrina's. And just the history there with, the truckers coming into town, having to grab and go a sandwich, and you put the fries and the coleslaw right on the sandwich, and just the mix. You're making me hungry thinking about it. I mean, I love Permanente. I have one about a mile from my house here. My wife lets me go there like once a month, maybe.
Yeah, there's a little bit of cholesterol in those sandwiches. No doubt.
There are, but it's a terrific sandwich. So.
It sure is. Jim, thanks so much for chatting with us today. If the listeners want to hook up with you, if they want to connect, where can they find you?
Sure. james.bly@alliant.com, or shoot me a text, 412-522-4529.
Outstanding. I bet you hear from some of our listeners. Thanks again, Jim.
Thank you, Peter and Michael. It's been a pleasure. Enjoy working with you guys.
Thank you.
Thank you.
Thank you for listening to The Building Bite. This podcast has been brought to you by Proactive. Check us out on thebuildingbite.com, where you can subscribe to our newsletter and follow us on social media for all future The Building Bite news and updates. You can also find us on your favorite apps, including Apple and Google Podcasts, Spotify, Stitcher, TuneIn, and Amazon. If you have ideas for episode topics that we should cover on the show, or you know somebody who would be a perfect guest, let us know at connect@thebuildingbite.com.